Adjusting revenues. Adjusting revenues collected in advance. A client could pay a business in advance to conduct a service such as a feasibility study. So assume that on December 10th, a client paid $10,000 as down payment to the business. At that date, the business recorded the following entry: debit cash and credit unearned service revenue, since the service has not been provided yet. At the end of December, the business had fulfilled 60% of the feasibility study, which is worth $6,000. At this point, the business would record the work done as revenue for $6,000. It would do this by crediting the service revenue account and reducing the liability by the same amount by debiting unearned service revenue. Now let's assume the same situation, but the manager is sure that the business can complete the service before the end of the accounting period, which is end of December. So he asked the accountant to record it as revenue when the cash is collected, to save the accountant an adjusting entry at the end of the period. So the accountant debited cash and credited service revenue for $10,000 on that date. At the end of the period, the business noticed that only 60% of the service was completed, which is worth $6,000. In such a case, an adjusting entry is needed on December 31st to reduce revenue by $4,000 to keep $6,000 in the revenue account. So service revenue is debited. On the other hand, a liability must be created to recognize the business obligation towards the client. So unearned revenue is credited for $4,000. Let's focus on what happened to both the service revenue and the unearned revenue accounts. On December 10th, cash is debited and service revenue is credited for $10,000. If no adjustments are done on December 31st, service revenue for the period is counted as $10,000. However, since we know that only 6,000 of services are done, so we need to reduce the service revenue account by $4,000. That is the reason behind debiting the service revenue account for $4,000 on December 31st. This will make its balance equal to $6,000, which is the amount of revenue that should be recognized. On the other hand, the business must recognize that it is liable to the client with services that are worth $4,000. That is the reason behind crediting unearned service revenue, which is a liability account, by $4,000. Accrued revenue, or unrecorded revenue. Now let's assume that on December 10th, an old client asked the business to conduct a feasibility study. The business started working on the feasibility study without getting any payment. Towards the end of the period, on December 31st, the consultants informed the accountant that they are almost done with the feasibility study. So the work is almost done, and this should be recognized as revenue for the period. The accountant would record that by debiting the client's account receivable account to show that the client owes the business the amount of services done, which is $7,000. The accountant would then credit service revenue account to record the revenue within the current period's revenue. Now let's assume that the client paid the amount due on January 9th. In such a case, the cash account is debited and the client's account receivable account is credited for $7,000. Let's summarize adjusting entries for revenues. We have two types of adjustments for revenues. One type is regarding the revenue that is collected in advance before it is recognized. The other is for revenues that is accrued or not recorded yet. For the revenue that is collected in advance, we could face two situations. Either the amount is recorded as unearned revenue or it is recorded as revenue when the customer made the advance payment. If it is recorded as unearned revenue, the adjusting entry would be to reduce the liability, which is unearned revenue, and credit the revenue account to record it by the amount recognized for the work that is completed within that period. If the amount was initially recorded as revenue, then we need to reduce the revenue by the amount which is not recognized as revenue yet, since the whole amount was recorded as revenue before. So the revenue account is debited and a liability is created by crediting the unearned revenue account by the amount of work which is not yet carried out. On the other hand, if the revenue is done but not recorded, it would be credited by the amount recognized and the account receivable account is debited.